The word that sold it was not return. It was safe. That was the word Harold remembered. Not the pages of contract language. Not the surrender schedule. Not the cap rate. Not the rider fee. It was just safe. Harold was 69, retired, and tired of watching the market move like a broken elevator. Someone told him he could protect his money and avoid market losses. It sounded less like a product and more like a rescue. He signed because he wanted peace, but peace has terms and conditions. This is an educational story, not financial advice. Annuities are complex products with varying fees and tax situations. This is about a retiree buying an annuity because the word safe sounds simple. Harold is fictional, but his story is familiar to many retirees. He spent 41 years working for a grocery distributor. He was not a gambler. He just wanted predictable bills and a quiet house. He had Social Security, a pension, and $420,000. That amount looked large on paper, but it did not feel large to him. It felt like the last wall between him and every bill he feared. Property taxes, prescription costs, insurance premiums, food, and home repairs. The quiet fear that one bad year could undo 40 years of work. Then the market had a bad year, and Harold felt something shift. Losses in your 30s feel like math, but losses in retirement feel like time. That fear made him receptive to a single sentence about protection and growth. The presentation was polished, with charts and arrows everywhere. It showed market losses on one side and protected income on the other. It was not presented as gambling. It was presented as protection. Harold did not feel pressured, and that is important. Many mistakes happen because a product matches the fear a person already has. He was afraid of market loss, so they used the language of safety. He was afraid of outliving his money, so they promised lifetime income. He was afraid of making the wrong decision, so the chart made others look reckless. Harold bought it, and for a while he felt better. He told his daughter he had moved his money into something safer. She asked what it was. He said it was hard to explain, but the advisor had walked him through it. That sentence should make every family pause. Not because Harold was unintelligent, but because any financial product that controls a major part of retirement savings should still make sense after the meeting ends. The first year, nothing dramatic happened. Harold received statements, and he saw values listed in different columns. He did not fully understand why one number was higher than another, or why one number seemed connected to future income while another was connected to cash access. But the statement looked official, and official paperwork has a strange, calming effect. Then his roof needed replacement, and the estimate was larger than expected. Harold called to access some of the money. That is when the product stopped feeling simple. There were limits on withdrawals, and there were surrender charges if he took out too much too soon. There were rules about which value was available as cash, and which value was used for income calculations. There were fees attached to features he thought were included, and formulas describing how index gains were credited. There were terms he had heard before, but had not really understood. Participation rate, cap, spread, rider, surrender period, and guaranteed withdrawal benefit. None of this meant the annuity was automatically illegal, fraudulent, or useless. That is the uncomfortable part. Some annuities can serve a purpose for some people, and some retirees genuinely value guaranteed income. Some people want insurance against certain risks. But a product can be legitimate and still be misunderstood. A product can be marketed as safe while shifting the risk into places the buyer does not notice. Safety from market losses may come with liquidity risk, and guaranteed income may come with less flexibility. Upside participation may come with caps, spreads, or formulas that do not behave like owning the market. Extra features may come with extra fees, and a contract may protect against one fear while creating another. That is the hidden mechanism. When retirees hear safe, they often picture simple, but safe and simple are not the same thing. A locked door can protect what is inside. It can also keep you from reaching it when you need it. That is the visual model for Harold's story. His money was behind a polished locked door labeled safety. Outside the door, Harold was holding a roof repair bill. The problem was not that protection had no value. The problem was that he did not understand what kind of protection he had bought. He thought he was buying freedom from worry. What he actually bought was a contract with specific rules, and contracts do not respond to feelings. They respond to terms. That is why the sales word safe is too small. Safe from what? Safe from a market decline. Safe from outliving income. Safe from emotional panic. Or safe from inflation. Safe from needing cash at the wrong time, or safe from making decisions later. Those are different risks, and no product protects against all of them at once. Harold's daughter tried to help him review the paperwork. At first, he felt embarrassed and said he should have known better. But that is not the full lesson. The issue was not that Harold was foolish. The issue was that the product was easier to buy emotionally than to understand technically. That is a dangerous combination. A retiree can understand the fear perfectly and still not understand the product. Harold's situation shows why the word guaranteed can be confusing. People hear guaranteed and imagine every important part is protected. But a guarantee usually applies to something specific. Maybe it applies to a minimum interest credit or a future income stream. Maybe it applies only if the contract is held long enough and withdrawals stay within limits. Maybe it does not mean the account can be emptied freely whenever life becomes expensive. That is where many retirees get surprised. They do not confuse the product because they are careless. They confuse it because the emotional promise is simpler than the legal promise. The emotional promise says, "You can stop worrying." The contract says here are the conditions under which this particular benefit applies. Those are not the same sentence. When a retiree is exhausted from market fear, inflation, and medical bills, the emotional sentence is the one that lands. That is why families should slow down any product that has both a comforting story and a complicated rulebook. The more comforting the sales phrase feels, the more carefully the trade-off deserves to be examined. So before accepting the word safe, slow the sentence down. Ask what can go wrong, ask how money comes out, and ask what happens in year 25 and 10. Ask what fee is charged for each promise, and ask whether the income value is the same as the cash value. Ask what happens if you need a large withdrawal, and ask how the product is affected by taxes. Ask whether the person explaining it is being compensated for the sale. If the answer requires a diagram, a glossary, and 3 follow-up explanations, that does not automatically mean the product is bad, but it does mean the word safe was not enough. Harold did not need a product that sounded peaceful. He needed a decision he could still understand after the meeting ended. That is the real test. If you can only explain the product while the salesperson is sitting beside you, you may not understand it yet. If you cannot explain the trade-off to your spouse or your child, you may not understand it yet. And in retirement, misunderstanding can become expensive very quickly. The product behind the locked door may still have a purpose, but before you lock up part of your retirement money, make sure you know who has the key. Make sure you know when the door opens, what it costs to open early, and what promise is actually waiting inside. Because safety is not one thing, it is a trade-off, and the most dangerous financial word is often the one that sounds the most comforting.